Hello, and welcome back to our channel. Today, we're taking a deep dive into Mapletree Industrial Trust, or MIT, a significant player in the Singaporean and global industrial real estate market. Before we dive in, an important disclaimer. The information presented in this video is for educational and informational purposes only. It is not intended as and should not be considered financial or investment advice. I am not a licensed financial advisor. All investment decisions involve risk, and past performance is not indicative of future results. Please conduct your own thorough research and consult with a qualified financial professional before making any investment decisions. The creators of this video are not liable for any financial losses you may incur. Now with that covered, let's get back to the analysis. We'll be dissecting MIT's latest financial results for the first quarter of the fiscal year 2025/2026, exploring their strategic shifts and what this all means for potential investors. We have a lot to cover, so let's get right into it. First, a quick overview for those who might be new to this REIT. Mapletree Industrial Trust, trading under the ticker ME8U on the Singapore Exchange, is a real estate investment trust with a primary focus on income-generating industrial properties. While its roots are firmly in Singapore, MIT has been strategically expanding its portfolio to include data centers across the globe. As of the end of March 2025, their assets under management stood at a substantial 9 billion Singapore dollars. This portfolio is geographically diverse, with 83 properties in Singapore, 55 in North America, and 2 in Japan. The properties themselves are a mix of data centers, high-tech buildings, business parks, and other general industrial facilities. To better align with their growth strategy, MIT has reclassified its portfolio into 3 core segments: data centers, high-tech buildings and business space, and general industrial buildings. MIT is backed by its sponsor, Mapletree Investments, a global real estate giant. This relationship provides MIT with a significant advantage in terms of deal flow and industry expertise. Now, let's get to the heart of the matter, their latest financial performance for the quarter ending June 30th, 2025. The headline figure that caught everyone's attention was the distribution per unit, or DPU, which came in at 3.27 cents. This represents a 4.7% decrease compared to the same quarter last year and a 2.7% drop from the previous quarter. The total amount distributed to unit holders was $93.3 million, down 4.1% year over year. So, what's behind this decline? It's crucial to understand that this wasn't due to a broad operational failure. Instead, 2 main factors were at play. Firstly, there was a lower cash distribution from their joint venture, the Mapletree Rosewood Data Centre Trust. This was a direct result of higher borrowing costs as their interest rate swaps matured and were repriced at today's higher rates. Secondly, the DPU in the previous year was boosted by a one-off divestment gain from the Tanglin Halt cluster, which wasn't repeated this quarter. Despite the drop in DPU, it's not all bad news. Gross revenue actually saw a slight increase of 0.3% year over year to $175.9 million, and net property income grew by 0.8% to $133.6 million. This resilience was driven by contributions from a new acquisition in Tokyo and the completion of fitting out works at their Osaka Data Centre. Strong rental renewals and new leases within their Singapore portfolio also played a key role. This highlights an important takeaway for investors. Headline DPU figures can sometimes be misleading. It's essential to look at the underlying operational performance. In MIT's case, their core properties are performing steadily, but external financial factors, particularly interest rates impacting their joint ventures, are creating headwinds. Let's zoom in on the operational health of MIT's vast portfolio. As of the end of June 2025, the overall portfolio occupancy stood at a healthy 91.4%. The weighted average lease to expiry, or WALE, a key indicator of income stability, increased to 4.5 years, providing good visibility on future rental income. The Singapore portfolio, in particular, continues to be a pillar of strength. The average rental rate here has climbed to $2.31 per square foot per month. More impressively, the trust achieved a weighted average rental reversion of about 8.2% on renewed leases, meaning they are successfully leasing out space at higher rates than before. In terms of financial health, MIT's aggregate leverage ratio was 40.1% as of June 30th, 2025. However, following a significant divestment of some Singapore properties, this is expected to drop to a more comfortable 37.0%. They have also been proactive in managing their debt. Around 79.7% of their borrowings are hedged against interest rate fluctuations, providing some protection in the current environment. The average borrowing cost for the quarter was a manageable 3.1%. However, it's important to note that approximately $597 million of their interest rate hedges are set to expire in the current financial year. This means that as they refinance, they will likely face higher borrowing costs, which could continue to put pressure on distributions. One of the most exciting aspects of the MIT story is their strategic pivot towards data centers. This is not just a minor shift, it's a core part of their future growth strategy. The global demand for data centers is exploding, driven by the rise of artificial intelligence, cloud computing, and the overall digitalization of our economy. MIT is positioning itself to be a major beneficiary of this trend. Their recent acquisitions in Tokyo and Osaka are clear evidence of this strategy in action. The completion of the final phase of fitting out works at the Osaka Data Centre, a high-quality, fully fitted facility, is a significant milestone. This property is 100% leased to an established data center operator with a very long WALE of 17.4 years, ensuring a stable and long-term income stream. But it's not just about buying new assets. MIT is also actively rebalancing its portfolio. They recently announced the divestment of 3 industrial properties in Singapore for $535.3 million. This move unlocks value at a premium to their market valuation and provides the capital to reduce debt and reinvest in higher growth opportunities like data centers. This capital recycling strategy is a sign of a proactive and disciplined management team. They are not afraid to sell mature assets to fund future growth, a crucial capability in today's dynamic market. Of course, no investment is without its risks, and it's important to have a balanced view. MIT is navigating several headwinds. The most immediate is the pressure on DPU from higher borrowing costs, as we've discussed. But beyond that, there are some concerns within their North American portfolio. A few significant tenants have indicated that they will not be renewing their leases. While MIT is actively working to release these spaces, this does create some near-term uncertainty and could impact occupancy rates. The broader macroeconomic environment also poses a risk. Rising trade tensions and a potential global economic slowdown could dampen demand for industrial space. It's also worth noting that MIT's share price has underperformed the broader market over the past year. This suggests that some investors are cautious about the near-term challenges. So, with these competing factors, what is the consensus among market analysts? Generally, the sentiment is positive, with most analysts maintaining a buy or add rating. The consensus is that while there are short-term headwinds, the long-term growth story, driven by the data center strategy, remains intact. Analysts are essentially looking through the current challenges and focusing on the future potential. They see the strategic pivot to data centers and the strong performance of the Singapore portfolio as key drivers of future value. However, there are some more cautious voices. They point to the risk from the North American lease expiries and the broader economic uncertainty. This divergence of opinion highlights the current transitional phase for MIT. So, to sum it all up, Mapletree Industrial Trust is at a fascinating juncture. They are navigating a challenging period of higher interest rates and some portfolio-specific issues, which has put pressure on their DPU. However, they are not standing still. The management team is proactively reshaping the portfolio, divesting non-core assets, and doubling down on the high-growth data center sector. Their strong Singapore portfolio continues to provide a stable foundation. For investors, this presents a nuanced picture. If you're looking for short-term, stable distributions, the current environment might be a bit choppy. However, if you're a long-term investor with a belief in the continued growth of the digital economy, MIT offers a compelling opportunity. Their strategic focus on data centers positions them well to capitalize on one of the most significant secular growth trends of our time. The recent dip in their unit price could be seen as an attractive entry point for those with a long-term horizon. As always, do your own research and consider your own risk tolerance before making any investment decisions. That's all we have time for today. We hope this deep dive into Mapletree Industrial Trust has been insightful. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and hit that notification bell so you don't miss our future analyses. Thanks for watching, and we'll see you in the next video.